Welcome everybody to this Bollinger Band session that we are going to start. Before we can dive into the concepts of Bollinger Band and see how we can trade it, a small brief about myself. My name is Bharat Jhunjhunwala and I am the founder of wavemetric.com. I have been trading in the Indian market since 12 years now, and I've been using Bollinger Bands extensively in my trading uh, with my tools, RSI and MACD and candlesticks. So let me tell you about one thing about Bollinger Band. Is that Bollinger Band is a very effective tool, especially when you are trying to trade in a shorter time frame. Suppose if you are an intraday trader, then you need a good tool to measure volatility. And intraday trading is all about trading volatility. So the Bollinger Band is one of the most effective tools when it comes to volatility. So let us begin today's session and we'll walk through some of the things. So markets are basically driven by four dimensions. There are four uh, phase that drives the market. First is the price action and the trend. We have to see what the trend actually is. When the price action is such that the charts that are plotted on the screen are making higher highs and higher lows, then we can decipher that the trend is moving in an upward direction, or we can say that it's an uptrend. We can also predict the market that it is going to be bearish or bullish by seeing the single price action bar. Suppose there is a pin bar formation or there is a hammer formation, anything like that. So you can read the price action by trend. You can read the market direction by using trend analysis and the price action analysis. Second is the momentum. Momentum, you have a you have lots of tool to measure momentum. Momentum is the derivative of price, and it leads the price. It leads the price action, and it can tell you where the market can move in the coming days. Right? How is the momentum of the market? Whether the market is moving up in the same speed as it was moving before, or the speed has reduced. So this thing will be measured by momentum, and we use RSI in measuring momentum. And if you are interested in learning RSI, you can visit our website wavemetric.com, and you see that there are courses for RSI also. Third is the volatility. Now, volatility is just a measure of fear and greed in the market, right? So basically, it gives you a idea whether it is the right time to trade in the market or not. Suppose when you want to trade in the market and you have moved into a stock that is less volatile, or the volatility is very low, or in a sideways movement. So you stay there in the same range for 10 to 12 days or 10 to 14 days and even months. And you keep holding that stock until and unless the volatility is, you know, sideways. It has moved sideways. There is low volatility in the market, no real movement, neither side. So you need volatility either side. If the volatility is high, the volatility is low, then the market is trending. In low volatility zone, the market does not trend. It trades in an area. And when the volatility is high, the volatility is fluctuating, then we can see that the market have started trending upside or downside anyway. So volatility, and Bollinger Band is a tool that measures volatility very nicely. So we use Bollinger Band to measure volatility, and we are going to talk about Bollinger Bands in today's session, of course. And third is the time. Fourth is the time. Time is basically, I'm not talking about doing time studies or time cycles or nothing like that. Timing can be done, or timing the markets can be done through classical chart patterns like triangles, rectangles, head and shoulders. So you can time the markets there. Suppose the ascending triangle formation is there, so you can time the market that once it gives the breakout, I'll enter that time. So it's a timing the market. So that is the way we define timing. Of course, you can use Fibonacci timing also in the market, but for me, the definition of time is classical charts pattern, not the sine waves or nothing. The time wave, time cycles. No, I'm not. I'm not interested in making technical analysis a very complex subject. Believe me, complexity doesn't work in the markets. As soon as you involve complexity in your trading, excuse me, you will become less effective in the markets. It will show in your trading, it will show in your profits. The day you will start analyzing more and more, you will start losing more and more. Keep your charts very simple, very clean, make it understandable, and it is more effective. Believe me, and try it, because I have gone through all these things. So this is what I was discussing in the last slide, that for price action we use candlesticks. For momentum we are using RSI. For volatility we use Bollinger Bands, and of course for timing we use price patterns. So this is the thing I discussed. So today we are going to talk about basically volatility, and it's a Bollinger Bands that we uh, use to measure volatility. So just an walkthrough of what we are going to learn during these 4-hour sessions that we are going to hold. First is the introduction to Bollinger Bands, just a preamble of what Bollinger Band, how it came into existence, and what it's all about. A little bit of logic and calculation, because until and unless you don't understand the logic and calculation of a tool you are using, right, it makes no sense, because you don't know why you are using a single tool, right? Then settings of the band, we will tweak with the settings, or what are the standard settings and can we tweak with the starting. This all we'll go through. 14 trading strategies using the band. So we are going to look at 14 trading strategies using the band, and believe me, one or the other strategy will be available in the market every day for you to trade. There are 14 strategies, and there is a lot and lot of opportunities will be there in the markets every day to implement these 14 strategies. Then we will see how Bollinger Bands is used to identify even trend reversals. So uh, this can be a surprising element for many guys, because using Bollinger Bands for trend reversal is a little bit of a thing that people haven't heard of. But yes, Bollinger Bands can be used to identify reversal of trends also. Then there is a dual time strategy. While using the bands, we will use dual time strategy to trade the markets. Then trading with dual bands, that means we will use two bands of different settings on the same chart, and then we will use it for trading. Then we will use the bandwidth, that is an indicator that is derived from the Bollinger Bands. Then we will use percentage B, that is also an indicator that is derived from the Bollinger Bands. And we will see how we can use Bollinger Bands with CCI, it is a momentum indicator. And also we will see how we can use Bollinger Band with MFI. It is then also a momentum indicator, but it is involves volumes also in its calculation. Then we will see whether we can, how we can trade in options using Bollinger Bands, how we can generate option calls and trade in options using Bollinger Bands. And then we'll conclude our session. So these are the things that we have to cover in coming 4 hours, and I hope we should cover. We may be able to cover it. Otherwise, we will extend the session. There's no problem with me. So let's move ahead. Before going on to the main subject and jumping there, I'll just want to tell you that we have recently launched an mobile application. Uh, so you can find it on the Google Play Store and also on the App Store. And there we generate trading calls every day, and that is uploaded in the respective sections, and also you will get assist in the, if you go see the knowledge base there, a lot of article on technical analysis, and also a lot of free mentoring sessions on it. So right now everything is free, so go and download it and enjoy it, and see how it sets in for you. So let us start with Bollinger Band and its introduction. So Bollinger Bands are powerful technical indicators that was created by John Bollinger. Okay, this is the man behind the Bollinger Band, and he created the Bollinger Bands. And even some traders will swear that solely trading with Bollinger Band strategy is the key to success. So this is a very true statement, because uh, trading with Bollinger Bands only, you can generate very high level of profits and very high probability trades. And it is a very true statement, because if you master Bollinger Bands, right, you can master the volatility in the market, and you can trade from intraday levels to even end of the day levels on the weekly charts, on the monthly charts, using Bollinger Band. But to be very precise, Bollinger Band tools should be used on intraday to daily to weekly. We should not go beyond it. And also in weekly, not in every setup, only in some setups. You should not use Bollinger Bands every setup on weekly. Yes, on the daily chart you can extensively use Bollinger Bands, because it works very well, and also on the hourly charts or 30-minute charts, as you feel. So Bollinger Band, encapsulates the price movement of a stock. It provides relative boundaries of high and lows. The crux of the Bollinger Band indicator is that it is based on a moving average that defines the intermediate term of the stock, based on which time frame you are viewing. So first of all, you get this word. It is the intermediate term of the stock. That means when you are using a Bollinger Band, you are using a moving average with it. The construction of Bollinger Band is such that a moving average is involved in the construction, and basically we use the 20 period moving average in Bollinger Band, and 20 period moving average defines an intermediate term trend in the market. So what I just told you, that we are going to trade intermediate trend. We're not going to trade the long term trade. We're not going to very short term. We are just keeping our time frame very relative, from 30 minutes hourly to daily, and in some cases we can move to weekly when we are going for a trend change indicator or something like that. Okay, the trend indicator is known as the middle band, and most of the charting application use 20 period moving average for a default Bollinger Band setting that everybody knows. The upper band and the lower bands are then a measure of volatility to the upside and downside, and they are calculated as two standard deviation from the middle band. So we have a middle band that is a 20 period moving average. It's a simple moving average, and we apply two standard deviation on it, and it creates a band around the price, which contains 90% of the price movement, and the Bollinger Band is made. So you don't have to calculate two standard deviation manually. It's all in the charting software. Any charting software you're using, we'll see how it is done. So this is the Nifty chart, and you can see that it is a vanilla chart, no indicators on it, nothing, just candlesticks up and down. Now you cannot make any sense out of the chart right now. The price are moving randomly. You will see that the price are moving in an uptrend, and they're coming down and going up again coming to the mean. So now when you overlay Bollinger Bands on them, the prices are defined between a context. Okay, now you will see that the Bollinger Bands are overlaid and the prices are maximum time contained under the Bollinger Bands. So it makes you feel little bit comfortable, and it defines the price that yes, the price is moving between the bands, the upper band, the lower band, and the middle band. So it defines the context in when you overlay on the price. So what a Bollinger Band chart will look like, as we saw in the last slide. The volatility bands are drawn around the price structure, as we saw on the last slide. Just let me go to the slide. So these are the volatility bands. These are the two standard deviation bands. This is the middle band, 20 moving average, and these are two standard deviation bands. So these are drawn around the price, so they can contain the price. It comprises of three bands, as we saw: the upper band, the middle band, and the lower band. The middle band is the 20 SMA, and the upper band is the standard deviation bands. The upper band is equal to middle band plus 2 standard deviation, as we have discussed before. The middle band is the 20 period simple moving average, and the lower band is the middle band minus 2 standard deviation. So very simple setup, very simple calculation, nothing complex, very simple thing. So here it is. So you can see it's the middle band, 20 period moving average, the lower band and the upper band are the 2 deviation each, plus and minus from the middle band. So this is the construction of the Bollinger Band. You don't need to calculate the standard deviations manually. Everything is available on the charting software. You just need to put the charting software on, and that's it. So let us see what Bollinger Band actually, what is this 2 standard deviation. So as we know that everyone have read in school also the standard deviation concept, that basically one standard deviation is 68% and standard deviation is 95%. So when we are applying one standard deviation, basically we are talking about 68% of the data, and when we are applying 2 standard deviation, we are talking about 95% of the data, right? And when we are applying 3 standard deviation, then we move to more than 99% of the data. Now this is the bell curve, and this is applicable everywhere. Okay, so suppose you are in a party. When you go in a party and there are 100 people there, and now you have to bifurcate them along with their heights. You know, you have to bifurcate. You have to set them in groups in regards to the heights. So you make a type of 3 groups. First is from 5 to 5.5. Second is 5.5 to 6, and third is 6 and above. So what you will see that around 68% people will lie in this group, around 95% will lie in this group, and very less, around 2% people will lie in this group. They will be outliers. So similarly, you will see in stock markets, suppose it's 100 people are trading there, so what you will see that how things are done, 68% people are making sure shot losses, because either they don't have a right way to trade, or they don't know how to trade, or they are trading on tips that are not backed by specialist experts. They're trading on, some people even trade on gut, because they feel that the gut is telling that Nifty will rise today, so they trade on gut. I have met traders who say that trade on gut. It is their gut feeling that they are telling that Nifty will rise today. So I have met people who have gut feeling also. So you're trading better. So 68% of the people in the stock market are losing money. Now 95% of the people in the stock market are either profitable or loss making. I mean, they are doing so. And only 2% of the people in the stock market are earning money. So this distribution is also through here. All right. So this is the bell curve that is applicable everywhere. So similarly, when we are talking about stock market prices, when we put one standard deviation, it contains 68% of the stock market movement. When we apply two standard deviation, it will contain 95% of the stock movement. And when we apply three standard deviation, it will contain 99% of the stock movement. So applying three standard deviation doesn't help us because it will contain almost every price action. So we have to play with one standard deviation and two standard deviation. For now, we are only talking about two standard deviation with 20 SMA as the middle band. Later in the course, we are also going to discuss about one standard deviation and how we trade them. For now, we are comfortable with 20 SMA as the middle band and two standard deviation, upper band and lower band. So here you can see the red line here is the one standard deviation. It roughly contains 68% data of the whole movement. The black line is the two standard deviation. It contains almost 96% of the data, 95% of the data, 95 to 96%. And the blue line is the three standard deviation. And if you look at these lines, you will see almost all the data is contained in this three standard deviation. That means the price action does not move beyond three standard deviation, very rarely. So using three standard deviation won't help us. So we have to play with two and one standard deviation. So Bollinger Band trading strategies. So many of us have heard that there are many technical patterns such as double top, double bottom, ascending triangle, symmetrical triangles, and then shoulder bottom, etc. The Bollinger Band can add extra bit of firepower to your analysis by assessing the potential strength of this formation. Now suppose if you are analyzing an ascending triangle and the triangle is ready to break out, and if you overlay Bollinger Band on it, you will see the contraction of volatility and also an ascending triangle. Then you may be double sure that the breakout is around the corner and it may happen anytime. So Bollinger Band will add an extra knack to your current analysis. Bollinger Band can help you to understand whether or not the stock is trending or even if it is volatile enough for your investment. On occasion, when trading with Bollinger Band, you will see that the bands are coiling tightly, which indicates the stock is in a very narrow range. As I have discussed in the introduction also, that how we can say how that whether the stock is trading or stock is trending by using Bollinger Band. When we see that the stock price is contained in a very tight zone and the Bollinger Band is coiling around the stock, then we can say that the stock is very less volatile and it is almost in a sideways trend, right? So Bollinger Bands are helping help in this thing, trading and trending markets in a very huge way. So the first strategy that we're talking about is the double bottom. It's not the double bottom, the W or the bottom that we trade in the price pattern. It's the Bollinger Band double bottom pattern. So first we have to identify our basic double bottom that we have learned on the classical charting software or the classical charting form, that we will have to figure out a double bottom, that is a W. The initial bottom formation tends to have substantial low volumes. Now you have to see the first bottom should have low volumes. This bottom should have low volumes. The prices close outside the lower band. The third is the price on this low should be outside the Bollinger Band. When you will see on the chart, everything will be clear. Just follow what I am telling right now. Automatic rally follows that generally take resistance at the middle band. Now after this will happen, Now this is a bottom, and a rally take place that take resistance on the middle band. All right. Now this happened. The price attempt to retest the previous low after the rally. Now after resisting on the middle band, the prices come down again and retest the previous low. This one. As this retest bar prints inside the lower band, this indicates the volatility divergence. Okay. So what we have to do? This band, this leg, or this bar or this leg should print inside the Bollinger Band. Though the first leg was outside the Bollinger Band, the second leg should be inside the Bollinger Band. The first leg should have substantial volume. At the second leg, the volume should substantially drop. Right? And what are the prerequisite? It should close under the band, inside the band. So technically what you saw, that on the first flow down, on the first move down, the power of bears were more because the volumes were much higher. It went up, took resistance at the middle band, came down again, and at this time you see dip in the volume. That means the bears have lost their powers. The volume is not such as great. Now it can move up from here, and it may so happen that for a session or 2 or 3 days, the price may move up. All right. So here you see, this is the Bharat Petroleum daily chart. The prices comes down and closes outside the band. There is an outside the band, and you see the volumes here. All right. It goes up, take resistance at the middle point, comes down and closes inside the band, and you see the volumes here. That means the bears have lost their strength, almost every strength here, and then on a substantial rally up. All right. So this is one setup. Let us see another chart. This is Bharti Infratel. Comes down, prints outside the Bollinger Band, take resistance in the middle band, closes inside the band, check the volumes. Now it moved up again. Now the question is this: where you will enter and where will be your stop loss? Let us see one more chart. First, the close is outside the band, moves up, take resistance at the middle band, come down again, closes inside the band, see the volumes, and it moves up again. Entry can be taken on candle confirmation here. Suppose the prices are going down, you find a bullish engulfing candle here. Above the high of the candle, you can take the entry, keeping the stop loss below the low of the candle. And if this low is lower than, suppose if this low gets lower than this one, then the stop loss should be the previous low. Simple technique, but very effective. Here you can see in Bosch, came down, closed outside the band, had big volumes, broke the central band, means they could not take resistance of the central band, but yet again this is a valid setup. A bullish engulfing candle, any trade that does not break the central band is more effective. You can note it down. Britannia Industries, resistance and central band came down again. Check the volumes and up again. This is a double bottom. This is what I was talking about. First close outside the Bollinger Band, taking resistance at the middle band, closes inside the Bollinger Band, check the volumes, and then bang. Now in this case, where you should put your stop loss, your entry will be above these three candles, because there is a gap area here and you will wait for this gap closure, and entry will be here above this candle. You should put your stop loss below this low. Lower of the two legs. So many people will ask you to put stop loss here, and this stop loss will tend to get hit. So you have to choose the lower of the two for using the stop loss. IDFC, central band, bullish engulfing, again high. Stop loss, entry will be above this one, above this candle, and stop loss will be below this low. A very simple and effective technique. Every other day you will find it in the markets to trade. So now we'll move to the next strategy, that is double tops. It is also a very effective strategy and works very well